Right now, someone is paying a financial advisor $10, $20,000, maybe $50,000 a year in fees and getting worse results than a free app on their phone could deliver. That's not an exaggeration. That's what the data actually shows. According to the latest Spiva scorecard, 79% of actively managed large cap funds underperformed the S&P 500 in 2025 alone. Stretch that out to 20 years, and more than 90% of professional fund managers failed to beat a basic index fund. And the people who hired them paid a premium for that losing performance. Now, here's where it gets interesting. Most people assume that hiring a financial advisor automatically means smarter investing, better returns, and a bigger retirement account. It feels logical, right? You pay an expert, they know more than you, and your money grows faster. But the truth is, the financial advice industry was never really designed to maximize your returns. It was designed to maximize their revenue. See, there's a difference between someone who manages your money and someone who grows your money, and most people never question which one they actually hired. Think about it this way. If you walked into a car dealership and the salesman told you he had your best interest at heart, you'd be skeptical. You know he earns a commission. But when someone in a suit and tie with a fancy office and framed certifications on the wall tells you they'll take care of your financial future, most people just hand over the keys to their entire savings. And that blind trust is costing millions of Americans a fortune. Not because all advisors are bad people, but because the system they work inside has a design flaw that rewards activity over results. Let's talk numbers, because the numbers don't lie. The S&P Global SPIDA US scorecard for 2025 found that 79% of all actively managed large-cap equity funds underperformed the S&P 500, and it wasn't a fluke year. Over a 10-year period through 2025, only 21% of active funds both survived and outperformed their passive alternatives. That means nearly 80% either closed, merged, or simply fell behind. Morningstar's active passive barometer for year-end 2025 confirmed the same trend. Just 38% of active funds survived and outperformed comparable passive funds. For US equity managers specifically, the success rate was only 37%. And Morningstar's own research showed that lower cost active funds consistently posted higher long-term success rates than expensive ones, which tells you exactly where the drag is coming from. And remember Warren Buffett's famous $1 million bet back in 2008? He wagered that a simple S&P 500 index fund would outperform a hand-picked basket of hedge funds over 10 years. The result was clear. Buffett's index fund compounded at 7.1% annually. The hedge funds delivered just 2.2%. The smartest guys in the room with billions of dollars in resources got demolished by an index fund anyone can buy for almost nothing. Now layer fees on top of that underperformance. The average financial advisor charges about 1% of your assets under management per year. That might sound small, but on a $500,000 portfolio over 30 years, that 1% fee can cost you over $140,000 in lost growth. You're paying more to get less. That's the math most advisors hope you never run. So, what does this actually mean for you? It means you need to stop assuming that paying more equals earning more. It doesn't. The data is overwhelming, and it means you have three specific things to look at right now. First, understand the fee structure. If your advisor charges a percentage of your assets under management, calculate exactly what that costs you in real dollars every single year. Don't just look at the percentage, multiply it by your portfolio balance. When you see the actual dollar amount leaving your account, the conversation changes completely. Then ask yourself, am I getting enough value beyond investment returns like tax planning, estate strategy, or behavioral coaching to justify this? If the answer is no, you're overpaying for underperformance. Second, learn what a low-cost index fund actually does. An S&P 500 index fund gives you instant ownership in 500 of the largest companies in America. It doesn't try to outsmart the market, it just mirrors it. And because the market tends to rise over long periods, this simple approach has beaten the vast majority of professionals decade after decade. You don't need a finance degree, you don't need a stockbroker. You need a brokerage account and 10 minutes. Third, if you still want to work with an advisor, choose a fee-only fiduciary. That means they're legally required to act in your best interest, and they don't earn commissions for pushing specific products. Third, ask any potential advisor one direct question. Are you a fiduciary 100% of the time? If they hesitate, you have your answer. This isn't about hating financial advisors. Some are genuinely excellent. This is about making sure your money is working as hard as you did to earn it. Now, let me be straight with you. The financial industry spends billions of dollars every year on marketing to convince you that you need them more than you actually do. They want complexity because complexity justifies their fees. But wealth building isn't complex. It's consistent, it's boring, and it's proven. If you've been paying someone to manage your money and you've never once compared your returns to a basic S&P 500 index fund, do that tonight. Pull up your statements, look at your actual net returns after fees, then go look at what the S&P 500 did over the same period. That single comparison could be the most valuable financial exercise of your life. And here's something most people overlook. Even if your advisor matched the index perfectly, after their fees, you'd still be behind. So they don't just need to match the market, they need to beat it enough to cover what they charge you. And the data says that almost none of them do consistently over time. And look, I'm not telling you to fire your advisor tomorrow. What I am telling you is to get informed. Know what you're paying, know what you're getting, know your options. Financial freedom doesn't start with a big paycheck. It starts with knowledge. And the fact that you're here watching this tells me you already get that. If this video gave you even one piece of information you didn't have before, hit that subscribe button and also hit the like button so this video reaches someone who needs to hear this before they lose another year of growth to fees they don't fully understand. Thanks for watching, and I'll see you in the next one.